with Juan Gonzalez.
And welcome to all of our listeners and viewers around the country and around the world. President Obama is leaving today for a 10-day visit to Asia with scheduled stops in India, Indonesia, South Korea, and Japan. In South Korea, Obama will attend the G20 meeting where U.S. monetary policy is expected to be high on the agenda. On Wednesday, the Federal Reserve said it will pump $600 billion more into the U.S. economy and keep interest rates at historically low levels. The short-term impact of the Fed's move, known as quantitative easing, has been a jump in stock prices across the globe. But many nations have accused the U.S. of waging a currency war by devaluing the dollar. Brazil's president-elect Dilma Rousseff said, quote, "The last time there was a series of competitive devaluations, it ended in World War II." China has accused the U.S. of uncontrolled money printing. By devaluing the dollar, the Fed is cheapening the price of U.S. exports and making foreign imports more expensive. In addition, the low interest rates are encouraging U.S. corporations to make massive investments overseas, cheaply buying up foreign real estate, natural resources, and stock.
Our next guest, Michael Hudson, says finance has become a new form of warfare. Michael Hudson's distinguished research professor at University of Missouri, Kansas City. A former Wall Street economist, he's the author of many books, including Super Imperialism, the Economic Strategy of American Empire. Michael Hudson, welcome to Democracy Now! Why warfare?
Well, the object of warfare is to take over a country's land, raw materials, and assets, and grab them. And in the past, that used to be done militarily, by invading them. But today, you can do it financially, simply by creating credit, which is what the Federal Reserve has done. It's created $600 billion. It hasn't gone into the economy. The head of the Fed is known as Helicopter Ben because he talks about dropping money into the economy. But if you see helicopters, they're probably not your friends. Don't go out and wait for them to drop the money because the money's all going electronically into the banks. And the Fed has said, we want to give the banks so much money that they'll lend it out so you can begin to bid up prices on real estate again and pull the banks out of the real estate negative equity that it's in. So the purpose, according to the Fed, is to raise the price of real estate, to inflate asset prices. But that's not happening. The actual banks have lent less today than they did in 2007, so the money's going abroad. And it's going abroad not really to buy foreign companies so much, but to speculate in currency. Now, the Fed and the Congress 2 weeks ago said, we want China to raise its currency by 20%. This would create billions and billions of dollars of bonanza for Wall Street banks, and it would enable them to earn their way out of debt by essentially looting the China Central Bank, the Brazilian Central Bank, the Turkish Central Bank, and the other central banks, because you can now borrow money in America at 1%. So you'd put down, let's say, $1 billion of your own, $1 million of your own money, borrow $99 million of the bank's money. That's $100 million. You'd buy Chinese currency, RMB, for $100 million. You then say, raise your currency by 20%, which is what the Fed's asked them to do. That means that your $1 million now is turned into a $20 million gain because $100 million is now worth $120 million. You've made a 200% profit. And for Wall Street, they deal in billions, not millions. And so this would enable the banks to make up their money by buying, essentially, foreign currency. They're doing the same in Australia. It's currency gamble.
Well, and meanwhile, the impact, because obviously this decision was made the day after the elections and at the Fed meeting. They saw what the political landscape was. There wasn't going to be any kind of stimulus coming from Congress, so they had to come up with a stimulus for Wall Street the day after the elections. But the impact on the American people of maintaining these historically low interest rates, you know, as we were talking earlier before the show, if you have a little bit of money in a savings account right now, you're getting virtually no interest. So you're in essence being pressured to end up going into the stock market to be able to get any kind of return on your money. Those who still have savings. The same thing with the pension funds. What's happening to the American people as a result of this same kind of policy?
Well, if they have money to put in pension funds or savings, they're only able to get about 1% if they keep it safe. Otherwise, they're taking a risk in the stock market. But the key is not simply lowering interest rates. The idea is to flood the economy with credit so the banks will lend out more debt. And if the Fed's policy works, then housing prices are going to go back up so high that most consumers are going to have to pay 40% of their income for housing. They're going to have to pay more money for credit card debt. The purpose is to help the banks make money at the expense of the economy. It's not to help the economy at all. That's the really important thing. When they say the economy, they mean the Fed means its constituency, the banks, and the bank's product is debt, and that's what they're trying to predict.
Is this inflationary?
It will inflate asset prices. It won't inflate consumer prices. It's actually deflationary for consumer prices, because if you're an American consumer and you spend 40% of your income for housing, 15% for debt service to the bank, 11% goes out in your FICA wage withholding, and about 10 to 15% in actual income taxes, that means that the average American has maybe 1/3 or 1/4 of their salary to actually spend on goods and services. So they have to spend so much on debt service and finance and insurance and real estate that there's no money to buy goods and services. So that's why so many stores are closing throughout the cities on the big shopping streets. It's deflationary for the economy, inflationary for the people who have wealth, inflationary for the banks, and it's the banks really at the expense of the economy.
But there is the reality now that the world has changed dramatically over the last 30 or 40 years, and you have now this sort of new independent force on the world scene, even in finance, which is the countries like China, Brazil, and other countries of the third world that are, in essence, standing up on some of these issues. What's happening in terms of their reaction? The
world is dividing into two currency blocks, and over the last few months, China has gone to Turkey, Malaysia, Thailand, and said, we want to avoid using the dollar altogether. They're treating it like a pariah currency. They're saying, well, let's make a currency swap. We'll give you our Chinese RMB, you'll give us your currency, the baht, and we'll do our trade in our own currency. We are isolating the dollar so that people are not going to use the dollar anymore. That's why the dollar is plunging on world foreign exchange markets. The whole world that America created after World War II of open markets is now closing off. And it's closing off really because the United States is trying to rescue the real estate market from all the junk mortgages, all the crooked loans, all of the financial fraud, instead of just letting the fraud go and throwing the guys in jail like other economists have suggested.
I want to play a comment from the Nobel Prize winning